All right, it's wrapping up 2025, and it has been a wild year for sure. There's been
Definitely.
an interesting market that we've all experienced. Bidding wars, houses sitting, not selling, selling in a day, interest rates dropping a little bit, that being super high throughout the year, the economy, the tariffs, all kinds of a crazy year for sure. But there's a few new topics out there that I think that we need to talk about, and I'd love to share our opinions and get yours as well. But the first one would be the 50-year mortgage.
Hmm.
There's been a lot of talk about that recently. Do you
Hmm.
have? I've got my opinion for sure, but I was curious if you've given it much thought.
I have, and I actually see both sides of the coin. I do have a preference, but I also see both sides of the coin. So, the premise or the thought behind why there's been so much talk about it and potential 50-year mortgages coming out is affordability. Affordability is something we hear a lot about, and what that means is that home prices and interest rates have gotten to a point where less and less people are able to afford the homes. And so that's what we're talking about when we talk about affordability. And so if you lengthen out that period of time where people can pay that mortgage over 50 years instead of 30, obviously notes the monthly mortgage would be less. So I understand the premise from that perspective. And I think that that is a pro from that perspective. However, when you think about the other side, paying on a house for 50 years, it's additional interest, and to build your equity, the amount of money that your home is worth versus what you owe on that home, it just takes so much longer. So I know that that's kind of the con side of the equation. What are your thoughts?
Well, I want to back up for 1 second. For those that don't have never bought a house or have not been through this point, so 30-year mortgage has pretty much been the rule of thumb for many, many years. And there's a 15-year mortgage, and you can do anything anywhere in between. You can do a 10-year, you can do a 20-year, but the two most common are the 30 by far, and then the
Mm-hmm.
15. And basically, a 15-year mortgage, the interest rate in the past has typically been less than a 30-year.
Mm-hmm.
And so you're paying less interest, but you're also paying your house off. You're building your equity much faster than a 30-year mortgage. You can do the same thing on a 30-year mortgage if you make multiple payments and don't just do your one monthly payment every year. They're calculators. You can look that up. You can pay it off in 20 years by splitting it up and paying every 15 days. But obviously, the 30-year mortgage is the pretty much the industry standard, and the majority of buyers, especially first and second time home buyers, are doing that 30-year mortgage. So that's kind of been the golden loan, if you want to call it that. I I always love thinking outside the box. I play devil's advocate all the time. Anybody in the office knows I'm called Mr. Negative a lot because I'm always coming up with the negative side of things, but it's not being negative. I just like looking at it from different angles. The first time I heard anybody talk about potentially having a 50-year mortgage, I immediately went negative. I do get the affordability issue, but if you do the math, and I'm not trying to say $200 or $300 a month is not a lot. That is a lot. That's grocery bills, that's vacations, that's not a car note anymore, but half of a car note or a third of a car note.
Mm-hmm.
And $200 or $300 a month is a lot of money to everybody.
Yeah.
But when you think about paying for a house over 50 years and what that truly adds to your cost and the amount of interest that you're paying for that house. So when you're paying off a house, if you buy a house for $400,000 and you finance it for 30 years, you're obviously going to pay several $100,000 more for that house in interest over that time period. When you start doing a 50-year mortgage on a $400,000 house, yes, it's going to save you two or three $100 a month in your note so you can afford more house, but you are drastically increasing the amount of money you're spending over the life of that loan. Now, some people argue, well, most people move every few years, so it's not that big of a deal. But what it does do, in my opinion, is it drastically reduces the amount of equity you're building in that house. And that equity is what people, whether you stay in a house for a long time or you're moving, that's what you're trying to build and increase as rapidly as you can, is build that equity, because that's the amount of cash that it's not liquid cash, but it's your money that you have earned. And on a 50-year note, it's going to take you forever to build equity in that house. So I get them trying to make homes more affordable, but this is not the answer, in my opinion. Now, there are some things that are being floated out there that I think are amazing ideas, and I'm not quite sure how they're going to make it work, but I'm super optimistic that they can make it work. First of all, for those that don't know, there are assumable loans, assumable mortgages. So if you find a house that, especially VA and FHA loans, if they are, if you've got these sellers that have a house that they may have 2.5% or 3% interest on their home, and they need to move. They don't want to move because they don't want to give up that great rate. It's a once in a lifetime rate.
Exactly.
But they can then offer an assumable loan to a buyer, and that buyer can come in and take over. They have to requalify. They still have to qualify and do
Just
the
like
bank, just like anybody. Absolutely.
Would.
But they can take over the portion of that mortgage that's left at that interest rate. It stays with the house. There's talk about making conventional loans. So conventional loans are not assumable. Every once in a while, there's rare case by case basis that I'm not going to say 100% of the time they're not assumable, but 99.999% of the time they are not assumable.
I've seen one that's assumable.
I haven't either, but there's talk about making homes, those loans on a conventional loan, assumable. Opinion, thoughts?
Yeah, so I think I want to take a step back and talk a little bit about why does an assumable loan even matter now? And I think as we think about the historical trends of interest rates, during the COVID period, interest rates went down significantly to historical lows. So 2%, 3%, 4%, those are not normal interest rates. They were during that period of time. They were very abnormal over the historical norms.
That's right.
And so I think that's the problem that government and lenders and those in the industry are trying to overcome for our buyers and our sellers, for that matter. So if you're in a home that's 2%, 3% for your interest rate, and then you want to upsize or downsize or whatever the case may be, the reason for your move, and now you're going out and looking at an interest rate closer to 6%, that's a big difference in terms of what you can afford.
Huge.
And so that's why we're having these challenges.
It prices people out of the market.
It really does. And so as the government and lenders and others in our industry look for creative ways to solve this problem, that's why we're learning more about a potential 50-year mortgage, assumable. We'll probably talk about portability in a minute too.
That's the one I'm most excited about.
Me too. I love the idea of that. But I wanted to showcase why it's these market conditions that are pushing us to be more creative as a society. I find that incredibly interesting. So back to assumability. I love the idea of assumable, that interest rate would stay with the house. I think that that's a great plan. The biggest opportunity is when someone has not paid down a lot of equity. So let's say you have a $400,000 house. If you've already paid $200,000 down on your house equity and you have $200,000 in a forced savings account through your home equity, then you can only assume $200,000 at that low rate.
That's right.
And that other $200,000 as a buyer, you would have to come up with either the cash or a second loan.
That's right.
To afford that. And so that first loan would be at that 2% or 3%, whatever it is for the house. And then that second loan would be at that 6% or whatever the market bears at that point.
Correct.
And so while it's less and a good thing for the buyer, you still have to take into account that equity part of it.
You do. And it is a good deal typically for the buyer. but it is not a good deal for the seller because the seller is still losing their 2 or 3 or 4, whatever it is, their low interest rate loan. They're still having to leave their home, let someone assume that loan, and they then have to go buy another house at the 6% or 5.75, whatever it
Right.
is, which is affecting, still, in my opinion, affecting how many sellers are able to sell. Even to your point earlier, even if they want to sell,
Right.
many can't. They
Right.
can't afford to, but because houses have gone up, just because interest rates went up, pricing didn't come down.
That's right.
The market slowed a little bit, but the prices have stayed steady for good properties. And so sellers are struggling to be able to afford another house. They can't even sometimes afford the house they're in right now at the higher interest rate. So this kind of moves over to that next one you mentioned a second ago about being able to carry your loan with you, and keeping that loan. That's the one that I'm most excited about because I think that could really potentially be a game changer for sellers. Sellers would be able to keep their current interest rate. So to your point earlier, let's use the same numbers. If they have a house that they it's worth $400,000. Let's say they paid $350 for it. Doesn't matter. They owe $200,000 and their interest rate's at 3%. And they want to go buy another house, and this other house is a $500,000 house. They will be able to buy this $500,000 house and keep their $200,000 current loan, but move it to the new house at 3%, and then take out a second mortgage for the difference of whatever else they need to borrow. If they need to borrow $150,000 or $200,000 or whatever that is on a second mortgage at the current interest rate. For me, I believe that's a game changer for sellers to be able to have them be able to afford to move, give them motivation to move, and feel comfortable in moving because they're able to keep that rate. I think that would be a total game changer.
Agree
Looking forward
completely.
to seeing how they progress with that. I know they have to. There's a lot that goes behind this. There's a lot of tax code and mortgage code and laws that have to be addressed in Congress, as well as all the lending rules have to be addressed and changed and looked at. So, but I'm super excited about that one.
And I love that we aren't stuck in thinking the old way. I like that this is pushing us. It's innovative, it's creative. And whenever there's a tough situation or a challenge, oftentimes we see so much progress that comes as a result of that. And I think that's what we're seeing right now in our industry. And it excites me. I think this challenge is going to lead us to better things down the road.
Agree, because right now, I mean, we are certainly in most cities looking at an affordability issue, and people are struggling to be able to afford a house. And it's for a multitude of reasons. Obviously, pricing has drastically gone up from where it was 6, 8, 10 years ago. Some of that is because of COVID and demand, and the low interest rates were a cause of that because people could afford to buy a bigger home and more expensive, and there was not a lot of inventory. Obviously, inventory issue is a huge deal. I do think that if we're able to help sellers get out of their current home to look for something else, it's going to open up inventory. And if you have a greater supply, then obviously it all depends on demand as well. But I think that pricing and will definitely continue to stabilize and not continue to go up the way that it was. We obviously need a lot of other things to continue to work as well, inflation and tariffs, and we can go spend all day talking about all the
Let's not do that.
different facets that affect affordability. But I do think that helping sellers get out of their current home and make it more affordable could go a long way on helping the affordability and inventory issues that we face.
One other question I have for you, I'm curious, and we haven't discussed this before, but timing. So when you talk about a potential 50-year mortgage, assumable mortgages, possibly portable mortgages, maybe that means as a homeowner, I should stay in my current house and wait for these new things that are coming.
You know, I almost look at it, and I'm not trying to be morbid, but I look at it almost like, well, I don't want to leave my house because there are bad people out there that might blow up a building that I'm in. You have to live your life. I'm not going to go travel to this country because something might happen like COVID and I can't get on an airplane and get back home. Well, what are you going to do? Sit at home the rest of your life and not live? I mean, you have to live your life. And who knows? These are just things that they are discussing. Who knows if any of them will ever come to fruition? We don't. We hopefully that they will. But if you want to move, if you want to buy, don't wait. Because what we can guarantee you, if you look at the last 100 years of real estate or longer, prices continue to go up. That doesn't change. We have more people, less land. It's just natural. Prices will continue to go up. Everything costs more to create and build. It's economics.
It's supply and demand.
So if you wait, the house you want to buy is going to be more expensive next year, more expensive the year after that, and therefore it's going to be harder to buy. Your monthly note's going to be more. All of those factors in. So don't wait on life and not live it and not do what's best for you and your family on what ifs. What if rates come down? Well, refinance. What if assumable loans take place? Well, they do, but it doesn't mean that the house you want is owned by somebody that's got an assumable.
It's available.
So what if you can what if it to death? Live your life. There's a saying that's been going around for a while since the rates got high, and it's date the rate but marry the home. And that's basically if you find a house you like and the rate's higher than what you want, buy the house and just date the interest rate that's current, because rates will fluctuate, and when they come down, you can refinance. So if you find a house that you love, that you want to buy, find an agent, find a lender, go figure out how to make it work if at all possible, and don't worry about the what ifs. It's great if something happens and we get something in the future, but who knows when it could be 5 years before they figure this out.
Sure. And the other thing I want to point out, because I agree with everything you just said, but also competition. And when I say competition for other sellers, if something comes out and everybody rushes to sell or buy, you're going to have competition with other houses to sell. Or if you're on the buy side, more buyers that are competing against similar houses or the same houses. So I think that there's a lot of market conditions that have to be considered too. Anything else you'd like to add?
I can't think of anything at the moment. Obviously, we're still very excited about these possibilities, but we just don't know when they're going to take place, if they ever will take place.
Yeah.
I think the best thing you can do is find professionals, find people that are knowledgeable, find a good agent that you trust, that you have a relationship with, that has a good reputation, that again, that there's a personality fit, and pick their brain.
Yeah.
Get them to explain how they feel. If they don't understand or don't know, that's okay. Maybe they can put you in touch with lenders that do, and do some research.
Exactly.
Go figure out what's best for you, and try to make the right decisions for you and your family.
Yeah. And all situations don't point to the exact same result or conclusion. So depending on your circumstances, we may have very different recommendations from person to person. Most likely we would. So as professionals, that's something that we should be up to speed on and know based on what you're looking for and what you're trying to accomplish. We could help come up with the right pairing and the right lender to help with that. The other thing is we'd love to hear your thoughts. What do you think about a 50-year mortgage?
Yeah,
an
absolutely.
assumable loan and a portable loan, and what do you think about that? That would be really interesting too.
So just some interesting facts that are out there right now, and that are mind-blowing for me, and this study just came out, is that the median age for someone buying their first home is now 40 years old, which is mind-boggling to me.
It really is.
And it goes to the affordability of housing right now.
It's exactly what we're talking about.
Absolutely.
We talked about portable mortgages, and just to be clear, they are not here yet.
No.
But incredibly interesting. So I love talking about them and exploring them in terms of the vision for potential things for the future.
Just for a little clarification as well on assumable loans, the majority of loans are not assumable, so you can't just, assume that you're going to find an assumable loan. Typically, VA loans obviously are assumable, FHA there as well, but conventional loans are not. So it just depends on the loan the seller has as to whether or not it's assumable. And as a seller, as somebody who owns a property, if you don't know, call your lender and find out, or go back to your documents that you signed at closing, because that disclosure that you sign, one of the first documents you sign, goes through all of the details of your loan, and in there is a spot that talks about whether or not it is assumable.
Yeah. And as a seller, it's important to know that, because even though it might not impact you on your next house as a seller, it can impact the marketability of your current home.
That's correct.
And bringing in additional buyers that might be interested in that.
That's correct. So, not trying to be negative in any way, shape, or form, but this will date me a little bit. I was obviously in the market back in the early and mid 2000s, and I saw the crash and the defaults that took place, that happened, in my opinion, because lending became way too loose. And the last thing that I ever want to do or push is someone to buy a home and lose that house. So, just because you can afford the note doesn't mean that you can afford the house. Think about your monthly expenses. And what we saw is that anybody with a heartbeat and a credit score of 300 could buy a house in 2005. Obviously, that's yes. But what happened was people were told they could afford X amount of home, and they would rush out to buy that house, and were super excited to get it. But what they didn't plan for was the water heater to go out, the HVAC system to shut down, their car to break down. Mm-hmm. And at that point, they had stretched themselves so thin on that mortgage that they were truly house poor. And when the first thing in life, and life always hits you, that's just part of life, throws different obstacles at you, they were then upside down. They couldn't afford to do X, Y, and Z, and it became a quick downward spiral, as well as the adjustable rate mortgages that everybody was doing, and the rates went up, and then they couldn't afford the house, and it was just a huge snowball, and it all hit, and the housing industry had a huge crash, and so many people lost their homes. It was horrible. It was something that I hope we as a country never see and experience again. Mm-hmm. So when you walk in a house and you see drawing on the walls from kids or stuff left over from when they moved out, it breaks your heart to see, families being evicted from their homes or foreclosed on their homes. And so I hope we never go through that again. But so one of the things that is near and dear to me, and I try to always preach to especially our first-time home buyers, make sure that you can afford the house, and not just the note, but life after the note. Make sure you can afford to fix something when it breaks. Make sure you can fix your car, buy a new car. If your car dies or you get hit, an accident and it totaled, you have to go buy a new car, and your car note's higher. You've got to be able to live. You've got to be able to get to work. So just because if they pass the 50-year mortgage, and God forbid, I hope they don't, but if they do, and you can now afford this house, doesn't mean that you should go buy this house. And I believe everybody should own a home if they want to own a home. I'm not saying don't buy it. I'm not trying to scare anybody. I'm not trying to be Mr. Negative. I'm just trying to be Mr. Realistic.
But also at the right time. Right, it isn't always the right time for everyone to own a home. Some people need to save more for a stronger down payment.
That's right.
Or improve their credit for a better interest rate. There are different things that folks should consider. And so being a responsible homeowner is really what we're advocating.
That is absolutely correct. Because home ownership is not just about that note. Mm-hmm. It's about maintaining that house. When you buy a house, you're responsible for the roof. You're responsible for the water heater. You're responsible for painting it. Because if you don't paint it, the wood rots. So you're responsible for that. Yeah, you have to maintain it, and you have to be able to afford to maintain it.
So we would love to hear your thoughts on these 3 topics. What do you think about a 50-year mortgage, assumable loans, or a portable loans? Please let us know your thoughts. Bye-bye.